mortgage broker based out of Doylestown. I'm a real estate investor myself, a couple residential properties in Central and Upper Bucks. If I can help anybody with knowledge about Central or Upper Bucks, or help structure a deal, I'm happy to do so. Justin Stranier.
Hi guys, my name is Tom Kelly. I'm in a real estate appraisal firm. We have like a team of 4 or 5 people that work for us. For the last 15 years, I accumulated rental properties. We're in the middle of 3 rehabs right now, wholesaling as well. A lot of the similar things you guys do in the back that you just talked about. We have some available. I think I have the same 2 in Germantown. I wonder if it's the same seller. But we're busy. That's why I'm here.
Okay. Would you please? So I'm Phil Falcone. There's plenty of seats up here, guys, if you want to come up front. I've been in the business since 1989. I'm addicted to real estate. I love this business. I don't do anything else. I don't want to do anything else. I intend to make millions and millions of dollars off of this down market by acquiring properties today at dirt cheap prices, and then somehow figuring out a way to survive for the next 10 years to enjoy the rewards. So thanks for coming out tonight. Jeremy and I, we have a million ideas, and we love to share them with people. And we're, we have some businesses that we're involved with. This gives us an opportunity to tell you about them. And we also, so part of this is an educational meeting, and part of it is a networking meeting. Networking in this business is absolutely critical. So a lot of meetings, they just have a meeting and there's a speaker and speaker talks, and you do some networking a little before, a little after, and that's it. Well, here we have more of like an organized networking. So what we do is we're going to break this meeting up, and we got started a little bit late, so we'll probably break it up like, I don't know, just before 9. And then we go over to Bertucci's, because there's no better way to network with someone than drink them under the table. So over a pizza too. So we like to go over there and just leave your books in the car and stuff and go over there. Jeremy has a book for sale called The Ultimate Success Secret that he was an author in on a chapter in that book. I have my book, Addicted to Real Estate. If anybody wants to check it out while we're talking, you can I'll just pass them around, and if you want to buy one, we'll autograph it for you at the end of the meeting. They're each $20. $20 for 20 years experience, so that's only $1 a year. Okay. So tonight the topic that we wanted to share with you is seller financing. A lot of people will, if you go to real estate meetings, a lot of people will say, yeah, I know about seller financing. I know what it is, and they may have heard of it or something, but it doesn't mean that they're doing it. And it takes some education, it takes some time to really look for these kind of deals. They don't just pop out of the woods. You gotta dig for them, you gotta look for them. But when you find them and you structure a good one, man, it's a great, great way to build your net worth and to build your cash flow. And it doesn't take that many seller finance deals to accelerate your net worth tremendously. So that's the topic of tonight, and that's what we want to talk about. So without further ado, I'm going to hand this subject off to Jeremy Ricci, who is by far the most knowledgeable person on seller financing that I've ever met. So, Jeremy Ricci.
Okay. So, Jeremy. So, yeah, I mean, this owner financing thing that Phil basically said that, now's the time in this market with the banks the way they are, the lending the way it is. I mean, there's a couple mortgage guys in here. I know Justin is, and Skip's a mortgage guy. Any other mortgage people in the room? But there's, you're seeing it. They're giving out a lot less loans. They take your application, and then they won't not take your application, but they'll take your application and they'll just wait and wait, and then you get we need more stuff, and then you get the denial, and then you get, So we're hearing a lot about that happening. Now, I've been buying real estate for 9 or 10 years now. So it's April Fool's Day, 2002, I think, was my first day self-employed. And that April Fool's Day, ever since then, never bought a house with a bank, so I've always used seller financing. So we'll talk about some of the different types of seller financing and the ways that you go about getting these sellers to involving the sellers in the financing. So anybody here ever bought a house with the owner financing? Anyone? Anyone? Skip? You bought a house with owner financing? Okay. So the power in the owner financing is the flexibility. I've also never bought a house that was listed for sale. I've always been belly to belly with the sellers, at the coffee table, or in their kitchen, sitting at the kitchen table, and doing deals with. Because I really think that the deal is not about the numbers. It's not about this paperwork volleyball that you play, ping pong, where you make an offer and then they counter offer, and you make an offer and then they counter offer. And that's what the traditional real estate world does. That's what most realtors do. It used to be that realtors back in 30 years ago, from what my mentors have always told me, was that the realtors were really the people, and the real estate agents were the people that could make a deal happen, because they would know have all these tools with installment sales and agreement for deed, same thing, all the different contracts and options, and really putting these deals together and constructing a well thought out deal. Back in the Carter administration, when you had interest rates in like the 17s and with 14 points or whatever it was, I'm sure it wasn't that high, but they were pretty high. Back then, you had to do seller financing because the banks, nobody could make, there's people that would get those loans, but most of the time they couldn't make them work. So, back in those high interest days, seller financing was very, very prominent. Now, the interest rates are really low. It's not that. It's the availability of credit. The banks really aren't lending. And, they're getting handouts from the government. So, and they're doing a lot of fee structuring too, where they're making money off their depositors with different fees that they're putting in place. So I think that's why this seller financing is important more than ever right now. I mean, when I go to a seller and I'm talking about seller financing, the basis of every transaction is the people that are in the deal have to be happier after the deal is done than they were before the deal was done. And it doesn't mean to be happy-ist. It doesn't mean to be jumping in their shoes. They just need to be better off, happier than they were before the transaction. And if that's not the case, absent of coercion, a transaction won't take place. So if they're under duress or something, then they might sign something they wouldn't normally sign. But pretty much before the transaction, they have a certain set of, I'm not going to draw, but they have a certain set of attributes that they have. Let's say they have a property with stairs and they want a single floor property. Well, you can't really put a dollar value on that. You can't say, well, a single floor property is worth a lot more than this two-story property, but to them it is. And value is subjective. Value is not objective. An appraiser can walk in the room and say, well, this is what this house is worth. But to them, they have stairs to deal with. They have somebody that broke their hip last week, that the house no longer meets their needs. And to them, it's not about what's this appraisal worth, what's this appraisal worth. It's about, this house isn't working for me anymore. I'm in that situation. I'm in a situation where I need to either add on or move, because I have 3 kids now, and we have a 3-bedroom house. So, my wife and I, we share a room.
That's good news.
It's good news.
My daughter has her own room, and I have 2 sons. They're 6 and 2, about to be 2, and they share a room right now. So, they're getting, as they get older, I got to think about a 4th bedroom. So, a 4th bedroom either is going to happen with another house, or it's going to happen by putting an addition on my house, right? And then you got to deal with the township red tape of your septic system's not big enough and all this other junk. So, you understand, like, I'm actually going to be in that same situation where, like, the house no longer meets my needs. I'm going to need something different. And to me, the value is not in money. So when somebody says, how much for your house, and they say, I need so much and I need cash. They don't need cash. Nobody needs cash. Absolutely nobody. You want to challenge me on that? If you went into a seller's house and they say, look, I need $100,000 and I need cash. You say to them, all right, well, if I give you $100,000 cash and we'll just pile it up on your dining room table, and then I'll have your house, I'll have the deed to your house, and you'll have the cash. And then we'll circle back like 6 months from now. I want to come over, and can I come by in 6 months and let's just stare at that big pile of cash? Can we do that? And what do you think they say? No, it's not there anymore. Well, what do you mean? You said you wanted cash. If you want the cash, just put it here and have it as a little centerpiece. It's what the cash can do for them that's really the important thing. And what it can do for them is not monetary. What it can do for them is, my daughter's going to college in 3 years. What it can do for them is, we want to buy a motorhome and travel around the country. We have 5 grandkids, and we really want them to have a great Christmas every year. So these are the things that you have to think about when the needs of the seller aren't these monetary needs. They translate into real human needs, like when you're dealing with real people. And it's all about caring enough about the seller to give them what they want while you still get what you want out of it. So if anybody thinks like, man, I got a great deal, If you didn't get a great deal, you don't find deals out there in the marketplace. Deals are created by the meeting of the minds. And this whole paperwork ping pong, it's like, how could you ever have a meeting of the minds if the minds never actually meet? Sometimes it's hard. Sometimes Phil and I own a real estate brokerage, and we have agents that work for us. We have a lot of investor-friendly agents. We have a lot of investors that are also agents. And typically, and I don't know where this comes from. How many realtors are in the room, or agents anyway? I don't know where this comes from, but a lot of times, they have this thing that, I don't know if it's from school or it's just something that they were taught with, but they want to keep the seller and the buyer away from each other. Maybe they think they're going to have like a conflict of personalities. But I always think, bring those people together, because when you bring them together, you can then make a deal. And that's when you can make a deal. Because you say, well, I made you this offer. Why, what is it about the offer you don't like? And now you can really get into that conversation. And if I was a real estate agent, then I think I would want that to happen more often than not.
I know a commercial realtor who put a buyer and seller together. They had an argument over a water heater. $1 million building deal blew up, and he never again would ever let a buyer anywhere near a seller. But I think it was just like some things happen sometimes, and you probably, it's much better to put them together and understand where their heads are at if you're having trouble getting a deal done.
Yeah, if you can't get a deal done, it's one thing. If the deal's a done deal, they've accepted it, then at that point it's a moot. But typically, the deals that I make are really structured deals that really I'm looking at what are the needs of the seller and how can I meet those needs. I've offered, I have an extra car right now. I've offered my car as a down payment on a property where the lady said, look, I want to sell my house. I need to get a car. I said, oh, well, I got a car. Is that what you're looking for? I can give you a car as a down payment, and I'll just owe you the rest. So and it's kind of using what you already have, or using what you can easily get. I've have friends that have given boats as down payments on houses, or give another house and as a down payment on a house. We have some land right now in Percy that I'd love to give that land as a down payment on like an apartment building, because when it's tough to sell something, don't be, if you're a seller, you're kind of in a place of weakness when you're a seller. But when you're a buyer, you're in a place of strength, especially in this marketplace. So my goal right now is, instead of trying to sell this land, I'm going to try to buy something with the land as a down payment. So now I'm a buyer and say, I'll buy your building for $1 million. Here's land as a down payment. It's my earnest deposit. And there could be somebody that takes that deal, that they don't want the hassle of tenants, but they wouldn't mind sitting on some acreage that when building comes back up, they could build on and make some profit. So, any questions about that? Just kind of addressing an offer to meet the seller's needs, and really caring enough about them to come together and make a deal. Any questions? Eric?
Jeremy, what if you don't have a boat, or you don't have a piece of land or something else big enough to put as a down payment? How else would you pitch?
Well, it's not necessarily what you have, but it's also what you can get too. So we made a deal with the lady, and the whole reason that she said, I need $5,000 down. And I said, well, what is the $5,000 mean to you? And she goes, well, that's a Dodge Charger for me. So I said, okay, well, I have a buddy that's a wholesaler and a car wholesaler. So maybe I can go to him and say, hey, go to the auction and what can we get one of these things for? Because if I can get it at an auction price, and let's say it cost me $3,000, she said $5,000. Well, heck, I can just give her the thing that she wants, and it only costs me $3,000, but the value to her is $5,000. You got it? So I mean, it's all about what. And not every time can you make these things fall into place. Sometimes cash has to be the equalizer, but there's often times that people will take something else. Most of the times, your currency in the exchange of a house most of my currency in the exchange for a house is typically a promise. So it's a promise to pay somebody. So say, you give me your house and I'll give you a promise. That's how it goes down. So same thing, one of the other types of seller financing, what I call seller financing, is a subject to deal. You're taking over somebody's payments. You're buying the house subject to an existing mortgage. The seller already has that financing in place. So I really consider buying a house subject to the mortgage, leaving that payment in place, another form of seller financing. They're still involved in it, they're still on the loan. So, another question?
Jeremy, a lot of sellers are concerned about the liability of having the loan still in their name. So how do you make them feel comfortable with an offer like that?
There's a couple ways. Well, the first thing is that, they're probably, I wouldn't sell somebody a house and leave it in my name unless I had some sort of guarantee or performance bond or something, right? But there are people who would. It's almost like when you hire an employee and you're like, man, I can't find the right employee, I've been trying 3 or 4 different people. Well, you just haven't found the right one that when you find it, you'll say, wow, this is the right person. Same thing with sellers. I mean, when you say, well, I wouldn't do that, I would do that. Most of the loans that we've taken over have been in arrears, they've been behind on payments. Or we're coming in reinstating the payments and then taking the loan over from there. So they're pre-foreclosure stage or what have you. And when we're making up their payments, we're actually taking them out of a bad situation, put them into a better, not the best situation, but better. Because they say, they typically say to me, well, what happens if you don't make the payments? I said, well, then you'd be no worse off than you were when you weren't making the payments, right? So I'm actually saying, well, geez, each and every month that I'm making your payments, it's going as a positive on your credit report. And frankly, we have deals that houses that we own, that we've owned for years, that we actually get credit card offers to our office for these people because their credit is now good because of we're making the payments. So I feel a little guilty about that because it's almost like their credit's good, but not because of them. So it's like, oh, geez, I'm worried that they're going to go out to Volkswagen Credit and go sign for a car that, oh, you got great credit. So, but the other thing is the other kind of if you want to know some of my canned phrases that I use, one of them is say geez, if I were to take over your payments, I only get paid when this thing sells down the road, because right now, it's not a selling market, so I get paid down the road. So that would kind of be, if I would not make your payments, that would be kind of like me showing up for work from Monday through Thursday and not coming in Friday to collect my paycheck. Because my paycheck comes when I can resell this house to some end user down the road. So if I don't make your payments, I don't have any chance to make a profit. So that's one of the the objection handlers that I use with that. Does that help?
Yes.
When you're going in and discussing seller financing with a seller, when you may look very much like a weak buyer when you're offering somebody, look, I'll give you $5,000 down and maybe $1,000 a month. I mean, that looks like a pretty weak buyer. But you look like a very strong tenant to them, right? So typically, what does a tenant give? They give first month, last month, right? So they're coming in with $2,000, let's say, or maybe $3,000, $2,500. But you come in and say, look, I'll give you $5,000 or $10,000 down and $1,000 a month. If this is like a landlord, you look like a really strong tenant. Now to somebody else, that's just to a bank, you're gonna make that offer, they're gonna say no, because you look like a really weak buyer. So you understand, like, one of the targeted markets to hit is landlords and retiring landlords. Retiring landlords, you know, what is it that they have? They have real estate that produces some income for them, right? What is it that they also have is management. And as somebody gets older, that's not a currency, you know, that they're willing to give up some cash flow in exchange for some free time away from that management. So can you all see, I mean, that's really a good offer to make to people that are what I call retiring landlords. The other one is tired landlords. Tired landlords are, you know, average life expectancy is 3 years of a landlord. I mean, not that they die, but that they stop landlord. So you got that as well. So, good.
For the landlord question, what kind of terms would you offer them as far as getting, you know, a lot of times they have like cash out or something.
Yeah, so what kind of terms would you offer them?
Yeah.
The terms have to make sense for them, they have to make sense for you. So again, it's all about what their situation is and what they're doing. A lot of times I'll approach them and say, let's look at your current cash flow situation. So I'm saying, how much do you get for rent? How much of that goes towards taxes and insurance? How much of that do you allocate for vacancy and management? Now, if they're not, they say, well, I don't have a management company. I say, well, yeah, but you're taking the time to do it yourself, so your time isn't free, you gotta pay yourself something. So typically, you know, 15% is a good number for vacancy and management, maybe even 25%, if you include vacancy and management altogether. So, you got an appraiser over here questioning it. Not me. But I'm thinking, you know, 15. If you have 15%, call it 10% management and 5% vacancy. I think that's pretty low. I think it's like, you know, I think you need to be in like the 20% range for your vacancy and for your management. So take out the taxes, take out the insurance, take out the vacancy and management piece of it, and you look at their tax returns, like repairs as well, and what their net is on their tax return. You could probably afford to give them that. You could probably afford to give them that each month, if it was great terms. So one of the things that I learned from my mentors, and if you haven't seen, one of the most creative guys that I've learned from, his name's Peter Fortunato. PeterFortunato.com. He's been an uber mentor of mine, and he's been very willing to help me in anything that any kind of deals I'm trying to structure. But he always said, you know, look, I can buy your house either two ways. I can buy it at a wholesale price, or I could buy it at a retail price, but with wholesale terms. And if you tell that to people, then they know why you're in it. You know, hey, we're in it to make a profit. There's got to be some wholesale level here. We got to do a wholesale price, which is what, you know, Eric will go in and make it, and Ed too. I mean, these get the wholesalers and Frank. You go in and they make an all cash offer at a wholesale price, right? That's what I mean. That's the game. Now that's the only game if you're going to sit there and turn around and resell it right away. But if the idea is to have a house long term and actually have this asset produce you cash flow, produce some net worth for you, you can make. If somebody in this room says they had a house that anybody here willing to sell their house to me for $1 million? So that was
To my
How many
house?
bedrooms do you have?
1.5.
Okay, so I'll have to give you.
4 bed, 2 bath.
I'll give you 3, 4 bed. I might do that one. I'll give you $1,000 a month until paid. So what's that? 10,000 months. So no, 1,000 months. $1,000 a month for 1,000 months. So you see, like you can pay $1 million. It's just a matter of when. You know, I can give you any price you want. It's just a matter of when. So obviously that's an exaggeration. But you know, I have an appointment on Monday to go look at the house where a realtor came out and they said, look, the realtor told us our house will be worth $250 after it's all, you know, said and done. And my first offer to them was $267. And here's how you do $267. I'll give you $110 now and $157 10 years from now. So you just 2 payments. You know, so that's, you know, you're talking about. Cash flow is one of the huge things. I should really draw a, see if I can do this here. Some smells. So first thing, all the benefits, the badges and burdens of a house are all the reasons that somebody would do a deal. So you have to split them up and say, what are the things that we can split up in a deal here? So the foundation of every transaction is the security of all the parties. So you want to know that the people want to know that they're protected. You know, especially if you're gonna give payments to them over 30 years, 20 years, they want to know that that they're protected. They're going to lean against the property. You know, maybe they want, if they're savvy, they might want to have like a confession of judgment against you, things like a hard money lender might ask. They might want to have a deed in escrow. I mean, those aren't things that I offer, but if somebody asked me for them, I wouldn't mind doing that kind of stuff. So making sure that you're secure in the transaction, making sure that they're secure in the transaction. What else do we have here? We have one of the benefits of owning real estate is the use of the real estate. So when you're doing seller financing, typically you're getting the use of the property. So if you're buying a house, you get use of the property. If you're leasing the property, you get use of the property, right? So there's different kinds of documents you can use when you're doing either seller financing or any transaction. There's this part we'll call growth. Growth is something that you can participate in or not participate in. Has anybody here ever done like a sandwich lease? Something like that? Or a sandwich lease, I mean, if you don't have an option to buy that house, all you're making is cash flow. You don't have any upside, right? You don't get any growth. The lease just controls the use of the property. It also controls the management, which I guess we'll add in here somewhere. The thrill of management. I don't know if that's a benefit, but. And then what else do you have? You have tax bennies, which is like your, number one is your depreciation of the property. So these are all things when you're structuring a deal to think about. What did I miss here? Profit. That's more the profit is more the buy sell stuff. You get profit. People that are flippers are used to getting profit. Growth is an investor term. That's for I'm going to hang on to the thing. I'll get growth. And use management, tax benefits, profit, security, growth. Oh, this one's good. Income. So these are all kind of like the way you can slice and dice a house. I don't know what that is. If you're buying on owner financing, we're talking about like the retiring landlords. What is it that they have right now? They have income, they have management, they have growth. Do they have tax benefits?
Yes.
Now they're retiring. So typically, if they've owned the house a long time, they probably don't have too many tax benefits. They lost their depreciation. It's gone, 27 and a half years. So they probably don't have the tax benefits anymore. Sometimes they do. Profit's not an issue. Security, well, we don't know about that. And they don't have use either, because that's use is only when it's not rented. They have use. So somebody that's selling their house, that's a retiring landlord. They probably would like to get rid of. They're probably willing to get rid of management and growth if they can only get income. And what's the other thing that they might want? So somebody that's retiring, what do they want?
Security.
Security. That's true. Time. So if you can give them time, and you can give them the income that they're used to, they might very well say, "Look, I'll take the management with it. We'll gladly do that. And hey, we're retiring. We don't really need the growth. This house has done well for us, but we do live on the income, so we like that." So if you can continue to give them some income, maybe not as much as they're getting, and their trade-off is they get to go free. They get to go on vacation. They get to go enjoy themselves. You see how that's a powerful conversation to have with somebody, where it's all a give and take. Look, I don't need all the benefits, but I'll take some of them and I'll leave you with some of them. So, any questions about this? All right, so there's also different structures with owner financing. I mean, a typical owner financing deal, I'm going in there and I'm paying them a retail price. Or, some people are very price sensitive. So there's a certain price they say, we're going to be, my first office that I bought was, it was 2 retail stores side by side. And the guy wanted $100,000 for these two little retail stores, and he just wouldn't budge at $100,000. Place needed a lot of work, so I said, look, I was like stubborn in my own head, saying, "There's no way it's worth that. There's no way it's worth that." And I thought about it, like, the guy wants $100,000, give him $100,000. So then you say to him, "Well, what do you need the $100,000 for?" And that's something that's a tough question to ask, but it's an easy question for them to answer. Sometimes they won't, but if you ask somebody, if I gave you all cash for this place, what are you going to do with the money? And they'll often say, "Well, it's none of your business." And you say, "Well, it's my money. I want to know what you're going to do with it." So
Next.
sometimes that works. And when you get into it, it's really the needs. Like this guy, I said, what does this $100,000 mean to you? And he says, well, I need to get myself a car, okay? I need to be able to pay my taxes every year because I'm on a fixed income, okay? I need to pay for my homeowner's insurance and my car insurance. Okay, got it. I said, that doesn't sound to me like that's a $100,000 problem. That sounds to me like that's a $500 a month problem. Because for $500 a month, you can get a car, you can pay your insurance, pay your tax. So he said, well, it was about a $630 a month problem. So that's the deal we made. We said, look, I'll give you $630 a month until paid on $100,000. He said, well, I'm going to need $25,000 down. Okay, what do you need the $25,000 for? He said, well, this one store here, I know I'm not open for business anymore, but I use this one store as a leather repair shop. And what I do is I make Civil War replica, Civil War belts and Civil War ammo pouches and all this stuff. So he said, I have all my machines here, and if I move, I'm going to need a garage that I'm going to have to build on the side of my house so I can put all this machinery, and I need to pay for the electrical wiring and all that stuff happening. So you realize it's not $25,000 that he needs. He needs a place to work. So what do I offer him? I said, I tell you what, I have 2 retail stores here. I don't even need all of this retail store. How about I just take the front half and you can be in the back half, and we'll just, you and I and your leather machines will share a bathroom, and I'll just rent out the other half to a tenant. And he goes, oh, well in that case I don't need the $25,000. So I mean, just the power behind saying, why do you need the money? Saved me $100,000, and then it saved me $25,000. And that's just all about caring enough about the needs of the seller to ask them, what's in it for them? What's in it for you? If I give you $100 grand, what's in it for you? So it's just, the deal beyond the deal is kind of just probing a little bit more. And I'm not, I'm saying it in a conversational way. I'm saying, what do you need the 25 for? And that made the deal happen. I bought that house for retail stores I still own them in Hatboro, and they were $1,000 down. And one of his other things was, well, look, I got to get this place cleaned up. I got to get this place cleaned up. We can't settle. We can't settle. He kept postponing settlement. I said, tell you what, I'll buy it from you now. I'll give you the $1,000 down, and we'll just agree that I'll pay you 3 months. I'll start paying you 3 months from the day that you have the place broom swept and cleaned out. And we'll draw up a little letter here. Here's the letter. It says, I agree the place is broom swept. I'll start making my payments on X. And we both sign that letter, and 3 months from then we start making the payments. And we closed that deal. And he was there for 6 months cleaning the place. But I owned it all the while, just because that was another concern. That kept the deal from happening. So I said, look, he didn't want to be under pressure to clean it out expeditiously. So he just said, I said, all right, that's not a problem. I just don't want to have my payments start until I get access to the property. I need a couple more months to fix it up. So that's just kind of like, all right, tell me what you need. I'll tell you what I need, and you understand I can't start paying you until I have a tenant in here. I can't start paying you while you're still in here, of course. So that's all, just the engineering of the transaction.
Did he realize that you would have taken that deal in a heartbeat and cleaned it up yourself?
A lot of the houses that I've dealt with were situations where people don't want to sell a house because they want to clean it out. Are usually people that have, are either pack rats or hoarding syndrome or a situation like that. And when that's the case, they want to go through everything. They want to actually open every box, see what's in there, make sure they're not throwing it. They won't take a box. Now, Phil will take, if you leave a check on the table, he'll throw it away.
Yeah.
That's not true.
And I'll be
But-
looking for it in a week.
Yeah. Phil throws everything away, and then the next day he goes, "Where is that thing?" Like, you threw it away. But some people hang on to this stuff, and they hang on to, I got the loan on, I got my car loan from TD Bank, and the day that I got my car loan, the guy gave me this pen. So I'm not going to throw that away. That's my pen, and that's actually the mentality of what goes on.
I'm like that.
Yeah.
I understand.
Yeah, I mean that's what happens. So, this situation wasn't so bad. I mean, I've had houses. The very first house I bought, I flipped the house, bought it for 50, sold it for 65, all in the same closing. And the contractors that I sold it to, they took 7 30-yard dumpsters full of trash out before they actually saw the carpets. So 7. This is a tiny 4-bedroom Cape Cod that was in Horsham, not too far from here. So I mean, there's and one of the things is, so in that situation, the guy says, I need to go through everything. And I said, all right, why don't you make a list of all the things that you want out of the house, and we'll get them out for you. So instead of like, not what you don't want, tell me what you want, and I'll get it out. And that's how we made that deal happen.
I have a story just to share with everybody on that
Stand up,
positive
Tim.
note. I walk neighborhoods very often, and I came upon a woman who was very depressed walking with a dog. And I approached her about if it was something I could help her with. And she just shrugged off, no, I'm just having a bad day. Well, the bad day ended up being a gold mine for me, because her bad day, and talking with her and kind of breaking the ice, she needed to move to Florida, and she had a fully paid off house and needed to go in 2 weeks. So I then, of course, nurtured that immediate situation, and I carry an arsenal with me of different types of phone numbers for help hotlines for different kinds of issues. So I told her, let me go to my car. I have a couple of phone numbers for you to call that will be assistance to relocate you. Now, I have an investor who could take your house right away,
Yeah.
and let's just find out what you need to go. So within that, now, sounds like it's easy. This happened within 15 minutes of meeting her. But then I went and had tea at the house, very nice house, and the long story short, the investor I brought this contact to took the house over. She got the money she needed to leave, to go down in 2 weeks. He bought the airfare, he bought a place for her to stay, and so forth. And it ended up being about $128,000 that he ended up assisting her with. And the house was sold after all said and done for $350,000.
Now answer this, was that a good deal for her or not?
For her, it was outstanding.
Yeah.
She could care less about that house. She could care less about all the things in it. But he hired a mover to come in and take all the things and relocate her properly, and it was good for her.
The why is much more important than the how much.
So I'm sharing that story
No, but that's
because
exactly what, that's a great
I come
point.
upon
Yeah.
a lot of different things like that where I have to act immediately and get it to the right person. I'm not the right person yet to do the deals, to do the actual
Sure.
contracts and so forth, but I
Yeah.
speak to
My
whoever.
grandfather always said, it's not what you know, it's who you know.
Mhm.
So it's having those contacts, you're being of service to her and getting her
Yes.
where she needs to be. I mean, and definitely of service to the investor and definitely of service to her. If you said to her after she's down in Florida in his house, would you do that deal all over again? She'd say, yeah.
Yes.
Absolutely.
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 And to boot, there was a nice fresh basket there of food and things in the house when she got there.
I mean, we had a house that the lady gave it to us for a song and dance. And her motivation, if anybody said, if somebody came in and said, well, let's just see if this is a balance of equities, they would say, absolutely not. But the why is so much more important. We had a house that the lady was raped in the house by her son. And she said, Jeremy, I'll give you a phenomenal deal in the house. I just don't want to ever hear that address again. I don't want to ever step foot anywhere near that place. I don't want to ever just promise me I'll never hear about that house again, and we'll give you a phenomenal deal. And she gives a really, really good deal.
I could share stories back and forth after.
But that's,
also.
I mean, we're gonna go to Bertucci's, so I hope everybody can come over to Bertucci's after this. We're gonna go hang out, and Tom's paying.
Just
No.
to add to that, I'm finishing a rehab near Pennypack Park in Northeast Philly, where the owner, he says, Tom, I know you're getting a good deal. This was after me going back and forth, terms, cash. My ex-sister, sister-in-law, brother, divorce, family, siblings, estate, blah, 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 crackhead, da. I know you're getting a good deal. Just take it off, get it out of here. Cash, quick, done. That's simple.
So that's the why. Again, the why is so much more important than the how much. Why are you selling this house? It's the first question that I always ask.
Oh yeah.
Why are you selling this? Or tell me about it first. And then, why? Okay, this sounds like a great house. Why would you sell it? Why would you sell a nice house like this? That's another thing Pete taught me. Pete Fortunato taught me that I use to this day. It's great. And then you just listen. And listening to the people is what allows you to structure a deal that makes sense for them. It's often tough when you have somebody that says, no, I don't want to say anything, and just make me an offer, make me an offer, make me an offer. And I typically say to people, I don't make offers. I make agreements. So when somebody sends me a purchase and sale agreement, how dare you send me a purchase and sale agreement? I didn't agree to this. Yeah. Let's sit down and find out what works. So, yeah. So a lot of the deals can be made just because of the circumstances, and the circumstances, of the people are much more important. So, all right. So let's move on to structuring deals. So I'll start with just the simple way to structure deals is, you need to buy deals that your tenants can afford to pay back. Does that make sense? I mean, you need to get terms, and this is something you tell people. Say, look, I need to buy this house with terms that my tenants can afford to pay. And in order for you to provide affordable housing, you can't have, I mean, how long are you going to be in business if you have a house that's got a $1,700 a month, note on it, and your rent is $1,000? How many of those can you do, right? There's some limit. So if you just talk to people like that and say, look, I'm going to rent this house out, and I plan on hanging on to it for the long term, so I'm not as concerned about, beating you up for price. I definitely won't do that. I'm not, and I always say that. I'm not one of those low ball cash offer guys. I'm just not one of those guys. If you want me to put on the low ball cash offer, I'm like hesitant to do it, but I mean, I'll do it if you really want me to. But what I want to do is make an offer, structure an offer that makes sense for you. And then it's when you get into talking about what their needs are. So typically a deal is, the best things are to get as little money down as you can put down, right? The less risk, the less money you put down, the less risk you have. And to get as small of a payment as you can get. Now, if you have a deal that's like $1 down and $1 a month, isn't that the best deal you can get? The problem is that they probably aren't going to accept a deal like that unless they really don't want the house. So you have to put together feasible deals. It's got to be feasible for them, feasible for you. So typically, a deal I'll put together is a little bit of money down, enough down that they know that I have some skin in the game, and then I'll structure a payment, and I'll show them why I can only pay so much per month. Now then the other thing that comes up is, let's say you extend the term of the loan. You say like, well, geez, that's going to go on for 23 years. And I'll be dead by then. I get that a lot. I'll be dead by then. That's like, well, geez, you have children, don't you? Yeah, we have kids. Okay, well, do you want to run out of money before you die, or would you rather take that money and pass it on to the kids and let them have that income stream? I mean, who wants to be on Social Security and then they get to 92 and they say, oh, that's it, no more monthly income, and then and they're 93 and then 94, the cash flow situation. So you always explain to people that they want their cash flow, their payments to outlive them. They don't want to outlive their cash flow. That's a good selling point to a seller. Most of the I never talk about interest with the seller. It typically doesn't come up. I'm pretty much paying them. If it's a $300,000 house, I'll give you $1,000 a month for 300 months. And if you wanted to, if they say, well, I'm not, if they really are stuck on, I'm not gonna live that long, then one of the things that I do is I will give them a balloon and say, okay, 15 years from now, I'll just owe you the balance. And in 15 years, you hope the house will at least double in value once, right? And you can then, do what you do, refinance or whatever you do. The other thing with the, if they happen to gripe about this interest thing, we often tell people, like, look, we're not looking to get a loan from you. We're looking to buy your house. So we're not asking you to borrow any money. If we were borrowing money from you, well, surely we would pay you an interest rate. But in this case, we're not borrowing money from you. We're discussing the terms of sale of your house. And I will agree to buy your house for the $300,000 that it's worth if you only would do it for $1,000 a month. That's the terms of the sale of your house. You're not giving me a loan. They say, like, well, I don't want to be the bank. No, banks have money. You have a house. Yeah. Don't say it that harshly, but look, I'm not looking to borrow money from you. I'm looking to buy your house. Here's the way I can buy your house. In this market, that speaks to people because nobody's buying houses, right? We should all be. So. Any questions about that? Any objections you get on that? Yeah. Go ahead.
You're obviously dealing with people that own their homes outright.
Yes and no. Yes and no. I
What are you
mean,
gonna do with the mortgage that they have to pay off?
a lot of times, and earlier I was saying, a lot of times we can take over their mortgage payments. Other times, one of the techniques is a wraparound mortgage. A wraparound mortgage will allow us to make a payment to them, and that payment would be all inclusive of their payment to whoever the underlying lender is.
You're gonna pass the acceleration clause?
I'm sorry?
You're gonna go past the acceleration clause in the contract?
Yeah, I bought plenty of houses subject to the mortgage, and never, ever, ever, ever had a bank call loan due because I bought it. Never had it happen, and I don't know of anybody that has. And the only time I've heard of somebody that had a loan call due on them is because the payments weren't being made. Now, if we get back to 12, 15% interest rates, and you have a 2.2%, Obama making home affordable loan, they might have a case to say, like, but then they'd have to go in front of a judge and keep a straight face while they say, oh no, we're not doing this because we want a higher return. So it is like the wraparound mortgage technique. The other thing with the due on sale clause and houses is if it's really like an issue, if it's really a stumbling stone for people, you can buy the house on a contract. You can buy it on an installment sale. So you can say it's kind of like a layaway program. Like, I'll pay you $300,000 for your house, and I'll give you $1,000 a month. Out of that $1,000, you pay your mortgage, and I don't even get title until the layaway is paid off, essentially. And I sold my previous primary residence. I sold that way, where I have a Countrywide now Bank of America loan on the house. I refinanced it and got a Countrywide loan. Then I sold the house to people who they couldn't get their own financing, so I sold it to them on a lease option. A lease with an option to buy it. And anybody know Section 121, the IRS code, Section 121, is the sale of your personal residence. You can sell your personal residence as long as you've lived in it for 2 of the last 5 years. It's code Section 121. It's the best tax code in the world. You can sell your personal residence.
Tax free.
Tax paid. It's not tax free. It's tax paid by exclusion. But you sell your personal residence, you've lived in it 2 of the last 5 years, or 720 days out of the last 5 years. It doesn't have to be even consecutive. And a single person can exclude $250,000 in gain. A married person can exclude $500,000 in gain. There's even a case in California where three gay guys had a house, and they were, I don't know, it just doesn't matter. 3 guys were in the house, and they each took $250,000 exclusion because all 3 of them owned 1/3 interest in the house. So they got a $750,000 exclusion in California. So that's a phenomenal. I mean, that beats tar off of Roth IRAs, 1031 exchanges. Move every 2 years. Yeah. You just have to have a spouse that likes money more than they like not moving. So that's the. But the point of that story, and can anybody tell I have enough ADD to diagnose 2 people? The point of that story was I needed to sell this house. For me to have lived in the house and sold it 2 of the last 5 years. Well, the moment you move out of your house, you got 3 years to sell it, right? So the moment I go 1 day after 3 years, I either pay taxes or I have to move in with my tenants for a day. Or, you know, if I go 2 weeks, I got to move in with my tenants for 2 weeks, right? So we were getting up on the deadline on this house, and I was about to blow up my 121 exclusion. And what I did was I changed it from a lease option to an installment sale. So essentially, I wrapped my existing financing with Countrywide, or Bank of America, with this installment sale, which was, I'll agree to buy the house for you on a contract over time. So that allowed me to, from an IRS perspective, that allowed me to freeze the sale of the house. And at that moment in time, 2 days before my 121 exclusion was about to expire, that house was sold. Now, I didn't get any cash out of that, but the house was sold from a timestamp perspective. Now, when they actually refinance it and cash me out of the house, I'll realize the profit. But if I waited and blew it up and sold it to them 5 days later, I would have had to pay taxes on. Like, I bought the house for $155, sold it for $325. So that would have been a big tax, windfall there. So that's just one of the ways with a wraparound mortgage or an installment sale that you can, a lender. I guess a lender could say that installment sale could be construed as the deed still stays in your name, but it could be construed as a sale from a due on sale perspective. But again, I've never run into that situation. That was a very long answer to a short question.
You just replaced your option that you gave the tenant buyer with the installment sale contract, which made it sold.
Yeah, they exercised their option
And bought it.
and bought a land
And then that
contract.
just happened to be
essentially, yeah.
payment until.
Right. Cool. So it's pretty much I turned lease to own into owner financing,
Got it.
and I'm not going to give you the deed until you give me all the money.
Correct. Right.
But at this point, it's not like they have an option to buy it.
No,
They have
they
an
bought it.
obligation to buy it.
Exactly.
Yeah. And I have an obligation to sell it.
Right.
So, question?
I'm actually dealing with an opportunity right now where the seller is, willing to be, creative with financing, willing to allow me to make the payments. They have a loan on the property right now,
Okay.
but they don't want the loan in their name anymore. I don't want my name either. So, what?
So what's the reason for them not wanting the loan in their name? You have to fear. What's the fear? There's a fear behind that, right?
Yeah, no, I know the reason, because they're buying another house.
Right.
And the lender said, you can't have this loan in your name if you want this loan for this house.
Yeah, that goes along with the financing being tighter these days. We had that, Justin. Did we do a deal with those people that? There were the people. There was a deal I was buying subject to a mortgage, but it was subject to a loan modification. So I said, I'll buy your house, not subject to your current payment, but I'll help you modify the loan, and after you modify the loan, I'll take over your payments. You remember that one? It was like we took our payment from like $10.95 down to like $6.50.
Right.
And for $6.50, I'll take over those payments.
Right, he has that option as well. We talked about that.
Modify it down?
He said, look, I can modify it down, and I said, that's great, it's
Yeah.
even a better deal for me.
Exactly, yeah.
However,
But they're the same situation. I have an option to buy the house, but I still don't own the house. Because they can't sell that house and go get another loan as long as it's in their name. And the lenders are saying, and you mortgage guys can vouch for this probably, the lenders are saying that you can't rent it out. We won't even consider the rental income. I don't know if this is still the case, but we won't even consider the rental income to you unless you've already a professional landlord where you've had it rented for a year. Is that still
Really?
Is that still true?
You need 30% equity
30% equity, which we
and
don't.
a 1-year history. So like with your situation, if the person's gonna make the payments for 12 consecutive months and you can document them, then they can exclude it. But obviously for your situation, they need to buy now and they need to get rid of the loan now.
And didn't they add also the 6 months cash reserve, each month's payment, the reserve cash?
Well, yeah, usually if
You have to have that too.
if you have several properties, you need to have 6 months of reserves.
And we're talking about people selling their primary residence, because this is what used to happen. We used to do this all the time.
Oh, yeah.
We used to do it where people sell their primary residence, and I would always tell them, look, it's much easier for you to have 2 loans in your name than it is for me to have 12 in
Well, you
mine.
could have a pending sale excluded 4 years ago. Like you could buy a new house with your existing house just up for sale, and it
Yeah.
wasn't a big deal. And now
Right,
it's
now
got to
you want
settle, or the way to get around it is if you can afford both payments. If on paper I can afford both payments, then it can be excluded.
Yeah, so that's something that's a challenge we ran into with them. Now, part of that is, okay, so if I can buy it creatively, subject to their modification, what I'd have to do is, and Justin and I talked about what the next step was. And the next step was find them a house that I can then buy subject to the payments and let them, you know, I would still be in the middle, but let them buy a house with owner. Like if I can negotiate owner financing on somebody else's house, I could then let them move into that house and then take over the loan. But you'd have to negotiate it on the other house, you know. They'd have to not use institutional financing on the new house.
You have to have
They
it
could-
set up.
But that's a good deal. I mean, find a house that they want that's behind on payments and say, we'll take over your payment book.
Problem, well.
But, you know, that's creative,
There's
yeah.
to it, they already found a house.
They want that house. Yeah. That's the problem. It's an owner
They
occupied.
have one they're in already, and this one's an investment property that they wanna get rid of. They have one that they're gonna rent that they're leaving. And this one's an investment property, that the one that I wanna buy, it already has tenants in it, already making payments. So it's, yeah, they were already told that they can't get the loan for the other house.
And that's all the banking thing. So that's kind of why we're here talking about owner financing and creative financing strategies, because the banks are holding up the works, you know, for lack of a better term. So, I mean, that's why I've always done creative financing. I was always taught, I think when I first learned from Ron LeGrand, the first seminar I ever went to, he was saying, there's only two ways to get in trouble in this business. Write big checks and sign your name on dotted lines. Because if you don't write big checks, you don't sign your name on dotted lines, you're pretty good. So,
Yeah, and people didn't really understand that until today. And they see what these banks have done to investors and done to homeowners. I mean, so.
I've seen portfolios of millions of dollars. We're dealing with a guy that had a portfolio of like $4.2 million, all bank loans, all cross-collateralized. And he owned his home free and clear, right? Owns his house free and clear, no mortgage on it. He's got all these other institutional debt, cross-collateralized, co-signed by him and his wife. But guess who's on the deed of his personal residence? Him and his wife. So him and his wife are on the deed. Him and his wife co-signed his cross-collateralized loans. So he's got this $2.8 million foreclosure problem, right? So what do?
Well, the house is toast.
Get a judgment against him, foreclose on his personal residence. First, foreclose on his personal residence.
Right.
He owned it free and clear, and they foreclosed on it. So I mean,
Because he owned it.
says he owned it in his personal name. Yeah.
There's builders whose parents co-signed some of their building and, you know,
Yeah, there was
10 lots foreclosed upon the parents.
So I don't know, I mean, you know, for them to get this new house without selling their old house, that's really the problem you're trying to solve, right?
Right, exactly.
So,
I've been challenged selling their Florida,
yeah.
but the house is up here, the house that I want to buy is in Philly,
Can you buy that, the new house for them?
the new one, that
Yeah.
they want to buy in Florida.
Is there a way to buy the new house without getting institutional financing and leave their institutional financing in place? Is there a seller involved, or is it a bank, or is it
It's the builder.
a builder?
The house is sitting there, it's.
Perfect.
Oh,
Builder's
he'll take-
perfect.
he'll take.
Yeah.
Builder's
If a dollar
perfect.
bill goes across the table.
The
The
builder's
house
a
is
perfect
sitting there,
one, yeah.
the house is sitting there empty, it's a
You
builder. it's a
buy it from the
development.
builder with the builder, let the builder leave. Now, they have anyway a construction loan, but I tell you what, the lender that has the construction loan, that is the person you want to go to. Not the lender. The lender who lent the builder that money has a construction loan out there that they need to get back. And they would much rather have an end user
With a new mortgage.
with a mortgage on that place instead of a construction loan to a builder.
Because
That's-
they're a
yeah.
commercial lender
Yeah.
too, and they will be able to hold the paper on that owner occupied
That's,
loan.
yeah,
They may go.
and they can make the decision, especially if it's a portfolio commercial lender, it's like a portfolio lender, they'll do that deal all day long. And, you know, I mean, because, you know, what's their alternative? What's the definition of a builder? Somebody that files bankruptcy every 7 years.
Or another way might be the financial institution, the traditional guideline is to have 12 months of consecutive payments to omit the rental property up here. You wouldn't want to do it, but you could put 12 months worth of payments up front and then probably convince the
See, I
bank
asked you that.
to omit it.
That was the first thing I asked you. They're like, yeah, they need to see 12 months of payments. I said, what if I just pay 12 months up front? And that was one of the underwriting things.
Well, once again, it's
That
just a
was, but it's
suggestion.
always changed. It's always changing.
But your bank was Bank of America, which, you know,
I forget, was it? I don't know.
yeah, I mean, that's
I
like.
forget who their loan was through.
It's like talking to this.
Right.
One of the things I just wanted to touch on that we didn't really talk about is just think about the And we talked about like the different things that you can negotiate, like the different currencies that you could pay in, you know, freeing up time with the management, you know, giving people the tax benefits, giving them some of these other benefits and keeping some for yourself. But, you know, the other thing is to think about all the different, when you buy a house and then you have a promissory note, what are all the components of that promissory note? You have like an amount, right? And we already talked about that amount. That amount could be, if there's no interest involved, the amount could be a higher amount. But there's also like the time factor. We're actually about to put a deal in on an estate duplex, and there's 4 heirs to the estate. So the first thing is you got to get 4 people to agree upon something, right? It's always a hard thing to do.
Right.
So I say, well, I was talking to Phil about it. I said, let's not get them to agree on anything. Let's put an offer where they can each choose which what they want. So they can say, okay, you can have 30 grand cash, or you can have $4,000 a year for 15 years. Was it 15, something like that?
Yeah.
So you could each have $4,000 a year for 15 years, or you could take 30 grand in cash and let each 4 circle which one they want. And then they don't have to decide collectively. They can decide individually.
Then you
So you're
divide
just
it
kind
up.
of parsing it up. It's like 4 notes.
Right.
Notes.
It's the same thing that we would do on any free and clear house. We would offer a low bulk cash offer, and we would offer a
No
very,
cash down.
very close, a no cash down, you know, no interest, seller finance loan, very close to full price. So all he did in this deal was he knew there was 4 people who probably don't get along, right? So he gave the same offer just to each of the 4, so that the 2 that are struggling could take the
Cash.
30,000 cash, and the 2 that are professionals and doing well can take the seller financing, and they don't have to even talk.
Make the Roth
And we're giving them a
kid every
retail.
year.
We're giving them retail asking price for the house. So it's a retail asking price offer,
Right, yeah.
full price offer. But we just said, look, the full price offer is based on all of you taking payments. So if any of you, if you all take the cash, we're ended up getting it at half price, right?
Wow.
So if 2 of you take cash, we're getting it at 75 cents on the dollar, but the rest of it's owner financing. And then the other part of that is, instead of giving them monthly payments, like who says you have to give monthly payments? I mean, I have tenants that pay me every 2 weeks instead of every month, right? So one of the ideas with that was, the lady who died was like in her 90s who owned this duplex. The kids they're in their like, you know, the kids have grandkids.
They're up there, yeah.
They're up there, so the kids have grandkids. So they have grandkids, so I said, all right, well, let's just make the offer instead of giving them so much per month, because you have to divide it 4 ways, and it's gonna be this like little number. So our offer to them is, we'll give you $4,000 every year on December 1st. So every year, December 1st, we'll give you $4,000. Now think about somebody that has grandkids, what that might mean to them.
Yes.
Hanukkah gifts, right?
And then he comes back 5 minutes later and he goes, wait a minute, let's give him the 4,000 when the taxes are due.
Well, no, there's five rental properties. There's five rental properties. There's 4 kids. So they each get a house, and then they got this one they have to split. So first of all, I mean, they're each getting a house anyway, right? So then at that point I said, well, geez, if there's 4 other houses, we could make the payment when the tax bill is due for the real estate taxes on these other free and clear houses. But I'm thinking like, nah, that's not good. You know, saying, hey, pay your tax bill with this versus buy your grandkids toys with this.
Right.
Different conversation.
Well,
So it's, you know, just
sometimes
a different way to.
you can build so much into a deal that nobody understands it anymore. So it's,
Oh, then you see the
I like to,
headlights, the deer.
yeah, keep it simple, keep it nice and simple. That's all.
Oh, yeah.
So.
You know, the other thing that's with the seller financing is important to know is the tax implications to them. It's important to know, you know, that if they have a place that's long-term capital gains, you know, they have to recapture all the depreciation that they took over the years, and then they have, you know, in this right now it's 15% capital gains. But if they get it all in a lump sum, they got to pay all that money in one check, boom, that year, right? If they take payments over time, they only have to pay the capital gains on the money as they receive it. So I mean, it's important to know the tax code as much as you need to, not only for yourself, but for the other person across the table. Because if you can show them how they can actually make a tax preferred transaction, that's some value that you're bringing to the table that nobody else is talking to them about.
Absolutely.
So learn about what's in it for them with taxes. So learn about retirement accounts, learn about their pension plans, learn about things like that, so you know what, you know, Social Security and how that affects them. What about a situation where you're selling where mom and dad are going into a nursing home? You think if they had a lump sum of cash in the bank, Who do you think is the first person going to reach out and get that
Nursing
cash?
home.
The nursing home, right. So if you structure a deal with them where the note isn't that valuable to the nursing home, that note could be there just to preserve their estate. Say no payments for 120 years, you know, whatever. And what's the nursing home going to do with that note? Nothing. You know, I'm exaggerating, but the idea there is you know, you talk to the kids about the mom and dad need cash for the nursing home. Well, we can qualify them for assistance as long as they don't have too much income. All right, so me giving you a big monthly payment is too much income. All right, we can work with that. You know, giving them a low income or no income with it, and having a future balloon might be a way to do it. You know, so you have to think about all the, you know, and that's like, okay, well, what's going to be good for you to go into this nursing home? What's not going to be good? A chunk of cash is definitely not going to be good. A high income stream is probably not going to be good. You want to qualify for as much Medicaid, whatever it is that you can. So just knowing, you know, what are all the parameters there. So, any other questions about owner financing or anything that I haven't touched on that you want to talk about? Back here first, and then you.
Yeah, when you do a wholesale deal, and you know you sell it to a cash buyer because you know typically selling to say an FHA buyer, it's very difficult to get paid on the HUD in the middle, right?
Get paid on the HUD on
Your wholesale
a
fee.
wholesale fee.
Right.
I don't know. I mean, that's you know, it depends what you do. Like you have, you know, there's people that have the assignment fees and do an FHA buyer, but you know, one of the things you can have is you can release a cloud on the title. So if you, like a lot of the wholesalers will record
Right.
an option to buy the property or whatever it is, and if they say, well, you can't assign that option, well, what if the seller were to pay you to cancel the option?
Right.
Or cancel your contract? Like I have a contract with a seller, what about getting paid a cancellation fee to cancel that contract because they found, you know, I'll pay you $5,000 to cancel your contract for $45 if you let me sell to this buyer for $52.
So
That's
if
the way.
you take that theory to like a sandwich deal, right? And you know you get an option and you move it to a buyer who winds up buying it, say in 2 years, and you want to, let's say your contract price was $100,000 and the end buyer is paying $125,000, and the end buyer has an FHA loan. How exactly do you get paid that $25,000 in that situation?
Outside of contract.
No, I mean,
Because the mortgage company.
well, if you're buying an option, if they're buying an option, they can buy the option anytime, and they're buying a piece of personal property.
Anything.
So, I mean, I had a deal with an FHA lender where I bought an option. I reserved an option from him. I bought a house for, I was 110 from a bankruptcy court. I put 25 in rehab into it, so I'm in it for 135. It was worth 175, but I sold it for 135. I sold it for exactly what I had into it, but the kid didn't have enough down payment money. So I said, well, you know, could he sell something that he had? Could he sell something for down payment money? Like, you wouldn't believe me trying to get this to the underwriters. But you know, so he said, like, look, I said, look, I'm going to sell you the house, but I'm going to sell it to you only for a little while. I'm not going to sell you the house forever. I want to buy it back from you when you're done with it. So I basically said, I'll sell it to you for 135, way under market value, if you give me the right to buy it back for 150. I reserved an option for 30 years. So so the thing is, they're looking at this option and saying, well, that option to me is valued at $15,000. So $15,000 was his down payment. And they go, well, where's the $15,000? They go, no. The $15,000 isn't his down payment. The option, he sold me an option. Him giving me the option as his down payment, that's what he gave. He said, look, so I was trying to explain this to the underwriter. I said, look, if the guy had a Corvette, could he sell the Corvette and raise 15 grand? Yes. Okay. But if he had a Corvette and I wanted a Corvette, could I just take his Corvette as a down payment? We talked about that earlier. And he said, yeah, we just have to make sure the value's in line with it. I said, okay. Well, if he sells me an option on a property he's about to own, he sells me an option to buy back the place he's about to own, as long as it's a bona fide, like it's any prudent business person would actually exercise that option. It can't be like, I'll buy it back from you for $1 million, you know, bajillion. But in this case, it's worth 175, and I had the option to buy it back for 150. Is that a good thing to exercise? Yeah. So at that point, I said, all right. So instead of me giving him $15,000 cash for the option, he's giving me the Corvette. He's giving me the option as his down payment on this house. So there's a situation where actually I got paid, or he got the down money on a HUD with an FHA, and his down payment was $15,000, value of an option. It was right on the hook, so I mean, there's a lot of things that you can do, yeah, but people don't understand, so you have to actually, I was on the phone for like an hour with the underwriter, twice. So, yeah, I mean, you have to find a title company that knows what they're doing in order to make it happen. And it's not just like, papers moving under the table, hiding stuff under rocks and winking 14 times, This is, you say, look, here's what I'm gonna do, show me what the guidelines are, let's look at the guidelines and study the guidelines and figure out how we can do it within the guidelines.
What title company would that be around here?
There's several, there's a lot of title companies.
You have a deal put together, give us a call,
Okay.
The right person
we'll give
for
you
the deal.
We'll give you the right person for the
Okay.
deal you've got.
Okay.
We have
My
different
title
people.
attorney is the same guy that Bart Gladstein uses,
Oh, okay.
that Tower Investments.
Yeah, Tower.
And then, I got other title companies that I use, depends on the situation. Another question you had, I'll be next time. Go ahead.
What are the property insurance issues when you buy a property subject to, or sell one subject to? Because the property insurance that the existing mortgage company is making payments to is protecting their interests, and it's based upon a certain owner actually living in the house. So who carries property insurance when a property is sold subject to?
So the owner of record is the person that should be the primary insured on a title policy, on a insurance policy, a homeowner's insurance policy.
Right.
So whoever the owner of record is. Now typically when we're buying it subject to a mortgage, if I'm buying it from the Jones family, I hold title and trust just because I don't like Pennsylvania saying that I need to give them $100 and their permission for me to form an LLC. It's like, forget Pennsylvania. Let me go back to kings and queens and common law. So I just hold title in a trust, and the trust is something I just hit print on my printer versus having to pay Pennsylvania and waiting and advertising and seeing if the name's taken. So I buy property in trust. I name the trust after them, so it'd be the Jones Family Trust. So by naming it after them, it's it's kind of like just homage to them, but it also it's the last thing that the seller wants and that I want is for the bank to say, hey, I'm going to call this loan due. So.
Oh, name it after the seller.
Yeah, we just name it after the seller.
Okay.
I name it after the seller. If it's a subject to deal, I'll name it after the seller. If it's a non-subject to deal, I just name it after the street. The
You
public
can call it due anyway, Jeremy.
Yeah, they can call it due anyway. If they want to call it due, they call it
Because
due.
of the trust, that's.
If they want to call it due, they'll call it due.
The idea is just to create the feeling that the property was transferred into the name of the trust, which happens to be the name of the person who has the loan.
Yes,
I mean,
yes.
some people actually even make like the initial beneficiary of the trust be the seller, and then they transfer the beneficial interest later. I don't even do that. I
You just
buy
keep
it.
it consistency.
I just keep it consistent. I just buy the name of the trust and be done with it. And what I do is I then get title insurance in the name of the trust. I'm sorry, I keep saying title insurance. I get hazard insurance in the name of the trust. I name the sellers as an additional insured, but not a lost payee, because I don't want a check cut where they have to sign it. Now, if I'm buying a subject to deal, I typically have a limited power of attorney anyway, so I can sign for them in any dealings with that house. So, I just don't want to have it where they cut the check to the trust. The bank also is a signature on that check, and then the seller, and God forbid I got to go track down the seller or something to do it. I like just, I don't name them as an addition, as a lost payee, just as additional insured. So I have the trust as a primary. I have the previous seller as an additional insured, but not a lost payee. The bank is in there as a lost payee, the mortgagee clause, whatever they do. And once I get that new policy, I then send that to them as a replacement for the old policy and say, here's the new policy. And then when I'm getting the policy, I get the policies in the mail, right? And the policies in the mail is addressed to the trust. And then I get another policy addressed to the seller, come into my office or my P.O. box or whatever. Typically it's my P.O. box. So then I just circle the property address. I circle the seller's names. I circle the insurance policy number, and I just fax it on over to them. And then once they call me back in, say, do you have the new insurance policy? Yep, we got it. And call the old insurance company and cancel the sellers. Because the new policy is a landlord policy now, because it's a rental property for us. The new policy, we're making a landlord policy. So on a subject to deal, on a scale of 1 to 10, I would say insurance is probably the hardest thing, and it's a 4. you know, but aside from that, stuff's pretty easy. I mean, it's not too hard. Once you do it once, my insurance agents know it now, like, they know exactly how to do it because they've done it, and they're like, oh, okay, I see, yes. Because really, the due on sale will happen if the insurance is canceled. The due on sale thing will come up, so what's going on, not due on sale, but what's going on with this thing? There's no insurance on it. You know, so they'll put that forced placed insurance. We've had that happen to us a couple times. So that help, or
Yeah.
any questions on that? Or?
I didn't digest all that as you were saying it, so I don't.
Bertucci's.
have questions right
Bertucci's.
now.
We'll go over his Bertucci's.
You give him a couple of beers and a pizza, and then he slows down.
It's actually-
And if anybody wants an explanation on anything he said tonight, just buy me a beer. I'll work it all out for you, okay?
The thing is, I don't drink alcohol, and with the ADD thing, it's actually caffeine that slows me down.
I didn't know if when you're still with, you're gonna talk about marketing or anything with seller financing.
Marketing with seller financing.
Mm-hmm.
You know, the message to the people has to make sense for them. So if your message is going to landlords, what are you going to be talking about? You're going to be talking about, I could buy your house and preserve the income that you have now and free up your management. You're talking about just free and clear people that are free and clear people. Free, that leans on my kids. Free and clear. The hospital might, right? If you're talking about just like a free and clear owner occupied property, you know, maybe the house is, hey, you know, there's a lot of upkeep. This house, you know, may or may not meet your needs. You know, I have a rancher now that we have somebody's rancher that we're looking to sell. That's through the brokerage, and I just thought of this now. I mean, heck, somebody that's what I do with that. I say, hey, I got a rancher to trade you for your 2-story house that you've owned for 30 years that probably doesn't meet your needs anymore. Within 5 miles of there. So that's the kind of list I would buy. Show me everybody that's got a 2-story home that they've owned for 30 years. That's within a vicinity of this rancher, because I know I could probably do I'll trade my who's-its for your what's-its.
Right.
Yeah. So, any other questions with?
Yeah.
Go ahead. This letter. Please.
Go ahead.
Go ahead.
No, mine's not a question. Go ahead.
When you go to sell the property that's in the trust, I mean, is there any problem? Because everybody wants to know, like, the identity, like with the, you know, with the safe, well, I don't know, the safe act or whatever, just they're all worried about terrorists. I mean, title companies want to know who you are. And what
Yeah, we don't make terrorists
so-
our trustees, and we don't commingle funds with beneficiaries that are terrorists. No, when you sell the house, the trusts that I create are just, they're revocable trusts, they're living trusts, inter vivos revocable trusts, or revocable, however you want to say it. So the trusts are born the day that I buy the house, and they die the day that I sell the house. And they just get dissolved because the asset of the trust that the trust is funded with just gets removed. So once the house is sold, the trust doesn't have anything as an asset, so therefore it's just defunct, it's done. So
But I was saying that when you go to sell the house and it's going to be deeded from the trust to the person, or are you saying you revoked it before that? It's in your name?
No. The trustee, technically, the owner of the house isn't the trust. The owner of the house is the trustee. The trustee owns the house for the benefit of the beneficiaries under a contract called a trust.
Right.
So
which I thought was yourself or something, but it could be something
well,
else, your family.
it can be yourself or whatever. I mean, it depends. I mean,
it could, I could have a daughter or something, but then, so with a trust like that, you're saying there'll be no questions, nobody's gonna.
There's questions, sure there's questions. Here's how it goes. I'm gonna sell a house and I have the trust. The title company says, look, we're gonna give an insurance policy on this thing. We need to know that you're giving us good title. So they'll say, in order to know we give us good title, we see that this is the trust and here's the trustee. We need to see the trust document. And then the trust document, they'll look at the terms of that, and like my trust document says that the trustee is only empowered to do anything upon the direction of the majority of the beneficiaries. So there's a consensus, the majority of the beneficiaries to sell the property. If a good title company is going to say, we need to see a letter of direction from the beneficiaries that directing the trustee to sell the trust. So they say, look, in order to get clear title, the trustee could sign it. And that's it. And most title companies will take that. But if the beneficiaries never told the trustee to sign it, it's not even good title. So what happens is they need to see that full document paper trail. Let's see the trust document, let's see what it says. they'll probably want you to have an affidavit that says, a finance says that the trustee is still the trustee, there's no further trustees, and none of the terms and conditions of this trust have changed. So they want you to sign that because it could change. So
why don't we-
Paperwork
what-
to sell an LLC deal anyway.
Same thing with LLC. Let's
Yeah, you
let's
gotta
see
get
the
a letter
operating
from the
agreement.
state
Let's get-
proving that
yeah.
they're up to date.
That's what I was gonna say to you.
Very
Tell
similar.
her at the table, you get your license out, they're gonna make a copy of this, show them your LLC paperwork, your operation agreement, whatever. They just want proof who you are, they can touch you, feel you.
Same
Yeah,
thing with
that's
the
what I'm saying, you're saying
Let's,
it's still worse than LLC.
Exactly.
All right, okay.
Why don't we go back for a second, because most people in this room haven't done seller finance deals, so selling a seller finance deal, you have to actually complete one first. I wanna focus a little bit more on like the mindset that the investor has to have when someone calls you. You got an I buy house sign on your truck, and someone calls you, okay? You don't know anything about this person or anything about the house, all right? So you gotta walk in there with the tools that you have in place to work with, all right? Seller financing is a tool, subject to is a tool. You can buy the house for cash as a tool. And you're gonna figure out in the first few minutes which one of these tools you're gonna be able to use on this particular house. And it's simple, you're gonna go in. I generally go in and say hello and spend 5 minutes with a little personal talk to, people wanna do business with people that they know, like, and trust. So let them know you a little bit, you get to know them, let them hopefully like you, and maybe they feel comfortable with you, that they're even beginning to trust you. Ask for a quick tour of the house, because quite frankly, the details of the house are, if you're doing this long enough, 5-minute tour, they want to tell me all about, there used to be a wall here. I don't care. I just want to look at your house real quick, 3-4 minutes, I'm cool. I don't care how big the place is, I get an idea, all right, I'm good. Now we sit down and we do you have a mortgage? You do? Tell me about it, How much do you believe your house is worth? So right away you know what they think their house is worth. It doesn't matter if it's even remotely close to reality. That's what they think it's worth. Okay? Do they have a mortgage? So you're quickly determining, where we're at with this deal. Now let's just say, for the sake of argument, that this is actually what's going to happen. Something like this, or something like this. It's either going to be a seller financed completely, a subject to completely, or a cash offer completely. Or what happens often is a combination of a subject to mortgage with seller financing, or a combination of a seller finance note with cash. So I'll give you an example of what the easiest deal we could think of is seller finance. The guy says, I want $100,000 for this house. The ones on the street are all selling for 80, but I'm not selling mine for 80. I'm selling mine for 100. But you've already determined that he owns it free and clear. So you're going to come up with his price. You're going to give him his price. That's critical. Your terms. His price, your terms. So you've established, I'm not one of those guys who's going to lowball you. I'm going to give you $100,000. Nobody will give you $100,000. I'm going to. Now you got his attention.
Give him 105.
Right? Then you go back to what Jeremy talked about. What can I rent this property for? I need the structure of terms, the payment, to be a payment that my tenants can afford. So you figure out what you can rent it for. You back out $300 a month in profit. You back out the taxes, you back out the insurance, and that number that's left is generally a good place to start. I like to go lower than that number, but you already know very quickly, what do you think this can rent for? $1,200 a month, minus $300, now you're down to $9. What's the taxes? What's the insurance? It's another $200, now you're down to $7. Very quickly you've determined that the maximum amount you can pay this person in terms is $700 a month until the $100,000 is paid off, whatever the hell that works out to be, okay? And you probably start, I'll tell you what, I think I could give you $500 a month for this. Would you be comfortable with that? And if you have to go up higher, you go up higher. So that's a way that you've done a strictly a seller finance deal. But before he signs the papers, he lays on you that he needs cash for some reason. All right, so now you're bringing in a little bit of your own cash. If it's $5 or $10 grand, it's no big deal. But what if the guy decides all of a sudden that it's $30,000? All right, maybe you don't have $30,000, but you know a private investor who does. Okay, so now you're structuring a cash offer which brings in a private investor. in combination with the seller financing. So I said, well, listen, you know, you're asking me for $30,000. It's a little bit of a surprise. I thought we were really close to doing a deal. Tell you what, I'll get you the $30,000. I'm going to give you $100,000 for the house. I'm going to give you the $30,000 in cash. Your seller financed note is now $70,000, but I want you to do me a little favor. I want you to take second position on it. To get the $30,000, he'll do it. He'll most likely do it. So you go to a private investor. This is now a beautiful deal, okay? You're not going to have any trouble in the world getting a private investor to lend you $30,000 to be in first position with $70,000 in equity behind it, okay? He's going to take that deal. And even if you have a seller financed, if you have a private lender who wants to be in a deal for 2 years, you could always pull him out and replace him with another private lender. So this is a great way to do it. It provides security for the private lender. You get the house, the cash flows beautifully because you're structuring the, now you might have to go back and renegotiate the terms that you're paying the seller finance note because now you got this private lender you got to make mortgage payments to. That happens a lot, okay? A subject to deal that's strictly a subject to deal is a house that's practically underwater. There's a million of those, so you're going to come across this all the time. It's a $100,000 house in his mind, but you're going to show him that the comps are really 80 right now, and he owes 71 on it. You say, look, there's only one way I can do this deal. I'll just take over your note. I'm not giving you any money. And many times we've said, look, you got to bring $10,000 to the table. A lot of people are afraid to ask that, but I'll tell you what, they say yes to that. More than you would imagine, they say yes to that. So there's a lot of deals where you're strictly doing a subject to. You're just taking over the existing financing. You're not going to pay them a dime more than what they already owe on it. You'll strictly take over the note. If they want out of that house bad enough, that'll be the easiest subject to deal you've ever done. I had people on the phone, pre-qualified. You know, I'll call them up. They called my truck. I got a giant, I buy houses on my truck, and they'll say, you know, tell me about your house. Yeah, it's worth about $100,000. And what do you owe on? I owe $88,000. You know, look, I know right away I can't do this. I'm not doing that. Right? I can't offer them $40,000 for the house because they got a note. So there's only one play here, one play only. I'm going to take over your subject, your mortgage, subject to, and I'm going to tell them right away.
After you find out about their
Provided the terms are
the
good.
structure of their payment,
Yeah, I mean,
number, so we can rent it.
I'm not trying to close the deal on the phone, but
Okay.
I'm going into this deal. By this point, I know exactly what the play is.
Gotcha.
Right? And I'm making them, you know, I'm make them pay my closing costs. Look, I'll take over your $88,000 payment on your $88,000 note on your $100,000 house, but you're paying my transfer tax and closing costs. And they'll come up with $5,000 to get out of the deal.
Phil, you're looking for some type of, like for these subject to, is there like a percentage of equity in-house that you'll do the deal, or like, obviously you'll walk away from a deal if it's, you know, totally underwater, but?
Well, in this scenario, I'm giving you a mortgage that's 90% of the value of the house. And then you've even got to ask yourself, do I want this deal at all? Because chances are that's a break-even or even a negative cash flowing deal. So you got to be careful there. Unless, you know, you have to make that decision for yourself. Of course, we've all done these deals where you just come in with cash and offer 40 cents on the dollar. That's easy. So now I explained seller financing and cash. Now how about a subject to and seller financing? This happens a lot too. A guy's got a $100,000 house. He's got a $40,000 mortgage on it. Well, he's not going to give you the house for $40,000, is he? Right? And that's easy. Say, I'll tell you what. You know, I'll take over your payments, and I'll make additional payments to you on the seller finance note. And then you just, in that case, there's no way I'm giving the guy a full price offer on his house. The more, in case you don't realize it, I just want to back up for a second. The seller finance note is absolutely incredibly powerful. This is a 0% interest note, so every dime that your tenants are paying you in rent, you're taking that money to pay off that mortgage. 100% of that payment is going to principal. Okay? You're getting $300 a month, plus you're getting 100% of that payment paid off on the house. Your net worth is going up rapidly, much quicker than any other deal you could structure. So the value in the deal really That's your most value. You could pay 40 cents on the dollar here, and here you could pay 100% of the value of the house. That's your best deal. That's your best deal if you can put it together. You need to ask for that. You get it, Jeff.
When you talk about the subject to in the middle, and you get your phone call that they owe $100,000, and that's pretty much what the house is worth, which is a common situation these days. How do you determine whether or not you really want to move forward?
I do extensive research. I pull up at their house. I go on to Zillow. I find out what the houses are worth 3 blocks away. I go in and go, the only way this deal could get done is if you bring $25,000 to the table, right? And that usually won't happen.
Typically, they don't have that cash anyway.
I know. What were you gonna say?
We just had a deal where they were gonna take it out of the retirement account because they didn't want to go to foreclosure.
It would come down to cash flow, I think,
Right.
wouldn't it?
Well, cash flow is a big thing, so.
That's huge. To answer his question.
Is that Ed was saying about would you buy a house if it's 110% loan to value?
Right.
Well, if it was a 2% loan mod payment, I might, right? Because if I can make $400 or $500 a month cash flow, do I care that it's 10% underwater? But you have to look at it and say, I wouldn't buy it if it was underwater and no cash flow. No, but if there's a heck of a lot of cash flow, I might.
Okay.
Or you could say, I might not buy a deal that's 80 cents on the dollar if it's negative cash flow because I don't want to do negative, you know what I mean? So it's
you
more than
could
one
actually
variable.
turn it upside down and you might still buy it.
Yeah.
actually.
You look at
Yeah,
all
it
the
depends
variables.
on
It's just one variable.
It depends on if you're getting cash flow,
Right.
which generally you're not. But occasionally we find ones that have unusual financing. But this is the key thing here. The reason this is so important, it's never been easier to do this than it is today. And I'll give you an example. We found these 2 Cape Cods in northeast Philadelphia. It was a mother and a son living next door to each other. And we made them offers for 100% seller finance notes. They agreed to take them both. And one of the reasons was their circumstance. They wanted to sell both houses right away. Now that's really hard to do today, right? They want to live together. They were going to move into a condo together and live together. The son's a nice guy, he's taking care of his mom. And we said, hey, we're the guys you've been looking for. We're going to buy both houses right now. We put together a very nice seller finance deal. Now, the value to those deals wasn't the houses. There were nice Cape Cods in northeast Philadelphia, and it's not many Cape Cods in northeast Philadelphia, but the amazing thing that we were celebrating was the financing. We just put together an amazing deal for financing. Well, right. You never want to. So basically, what that means is you never ever want to refi that or pay that off or sell that house because that financing is incredibly valuable. So you would think that we're stuck in that house forever, right? We're going to own that house for 30 years because that's what the payments are structured at, 30 years. But there's another way out of it, okay? You can walk the financing to another house, all right? The seller financing note is incredibly powerful. You want to keep that the rest of your life. You never want to, you're certainly not going to amortize that down early. You just want to move it. So what we talked about doing was, we were involved in a couple of other deals at the time, and we said, we had a private lender who financed, it was about $200,000 for this house we bought in Warminster. We bought it for $160 and we put $40 into it, so we had $200,000 into it, and we were paying an interest rate, and we said, hey, this is what we're going to do. We're going to sell one of these Cape Cods, and we were maybe even going to sell both of them. And then what we were going to do is we were going to say to the owners of those Cape Cods, because our contracts for the seller finance note had a clause in there that we would have the ability to walk this financing. So we said to them, would you rather have your $150,000 secured against a Cape Cod in northeast Philadelphia, or would you feel more comfortable having it secured against a $250,000 house in Warminster? Well, the $250,000 house in Warminster is a much more valuable house, and it also has probably much better upside. It's a better neighborhood. So if they said, no, you can't walk my financing, I said, fine, we're not going to sell the house. We won't sell the Cape Cod, we'll keep it forever, okay? But if they said, yes, we could sell one of them, maybe we got $225,000 for the house, right? We take that money and we take the financing and we just move it to the house in Warminster, keeping it, and we use the 225 to pay off the private investor, and we move the seller finance note to take its place.
What were the 150 each house, I think?
Yeah, they were 150 grand each house, and I believe that the payment was $750 for each house?
Yeah.
Yeah.
1,500 per month.
Right.
The neat thing is we buy the houses for 300, and this is kind of a neat thing for anybody with a financial calculator or does anybody here have, if you have like a situation where you have a high income and you need write-offs, check out this write-off. We have these two houses for 150,000, right? Well, the value isn't the houses because they're only worth 300,000, let's say. So we're paying retail for the houses, but the financing is a wholesale. So let's just say we just sell the houses for 240,000 for the pair. Let's just say we get 120. So we buy them for 300. The next day we sell them for 240. What does that look like on your tax return? Loss. It looks like a loss, doesn't it? Well, if you're walking these loans, if I have a payment of 1,500, was it 1,500, right? 1,500 a month?
Yeah, it's 1,500.
So if I have a payment on 1,500 a month with a present value of 240, right? Well, I just discounted my own note by selling the houses for less than I bought them for the next day. I buy a house for 300 today, I'll sell it for 240 tomorrow. And the trick with that is taking the Warminster house and taking the 240 and sticking it on there. So now we got 240 on here. Our payment's 1,500 on this Warminster house. These houses are long sold, and we have a $60,000 ordinary loss on our tax return, which can offset other income.
You paid the investor in Warminster with the proceeds from the.
Yeah, because this was like 10% interest only.
Oh, okay.
Right? I'm just saying, like,
No, I didn't-
that's
yeah.
why we did it, because we were like, okay, you have
Absolutely.
10% interest only, and over here you got 0%. So we moved it there. Now, the reason we're able to get $1,500 a month is a unique situation because, because they're taking two houses and moving into one condo. So the $1,500 a month was fine for them. That covered it. So that was kind of unique, the fact that they had two houses and they were going to consolidate to one smaller one. But moving that loan and discounting your own note, there's a huge amount of tax implications that are great. And then also just getting rid of more dangerous financing, whether it's a higher interest rate or it's institutional. Like if this was a 6% Wells Fargo loan, I would pay that Wells Fargo loan off, and I'd rather have a person on the house.
I'll tell you what, you could use it to pay off your own house.
Yeah.
All right? The point to all this is I don't want to sit here and give you 800 ways of things you can do with seller finance notes. The point is, the key message tonight is that these things are so valuable, that these things will improve your cash flow. You'll pick up beautiful homes. You'll structure the terms that are perfect for you. Instead of going around looking for a great deal, you're going to create a deal, all right? And you can find these things easy. I mean, just start dropping some marketing for free and clear houses. Or 1/3 of all the homes in Philadelphia are free and clear. I forget what the numbers were, 56,000 homes or something last time I looked. 28% of all the homes in Philly alone. The point is, if you can put one of these deals together, you can figure out a way where you're keeping that financing in place forever, all right? You can move it to a different house, move it to your own house. That's great. Like, suppose you had a $250,000 loan on your house. Well, go out and drop marketing to free and clear $400,000 homes until you find somebody who will give you a $250,000 seller financed house. Then sell the house, sell the house, take the $250,000, pay off your own home's loan, and move your seller finance note into position, and you just got yourself 100% of your monthly mortgage payments are going to principal.
And it's a human that's on the other end of the phone, too. It's important.
Yeah.
It's important.
Yeah. You getting all this?
The audio is for sale for $20.
There you go.
I know it's we're not trying to. Some people in the room are grasping it. Some people, aren't. But the point is, this stuff you have to. Even for me, I had to hear it over and over and over again. until it started to resonate. I want to touch on one thing before we get out here tonight, because I'd like to get over to the bar where I do my best thinking. Let's just say, so what I wanted to explain here quickly was, you get in front of a client. Now, I just gave you 5 ways. Seller financing, subject to cash, a combination of these 2 and a combination of these 2. And let's just say that you've met yourself, Harry Hardass, and nothing's going to work. Nothing's going to work for Harry, that's it. This guy, you can't get through his thick skull. It's like a coconut, and you just can't get through to it, okay? I'm a licensed realtor. I said, well, I'll tell you what, Harry. I got a perfect solution. Give me the listing on your house, okay? Now, what's that do for me? I'm a realtor. I just got a listing, okay? And I might be able to sell his house and make money off of it. But with Harry Hardass, the chances are that's not going to happen. So by being his listing agent, I become the liaison between him and every single person that comes to look at his house for the next 6 months. So as he's learning that the market will not pay him what he wants, his new buddy Phil is sitting there to walk him through the whole process of pain for the next 6 months. And as he becomes more reasonable, guess who's there to buy his house? Me. Okay?
I was thinking about all those other leads you get of people calling on his sign.
Yeah, no, we just had that. That's how we found you, right? This is Mark here in the green shirt. He called one of our signs, and we ended up doing a real estate deal together. But you get the point that if these, so getting a listing is the 6th tool, right? So I'm going in there with my 6 guns. I got 6 ways to shoot you down. I want this house, right? And some of them are quick, and some of them are complicated, and some of them require, you know, to hold his hand for 6 months and have the listing. But you get the point. What do you think my closure rate is on these houses? We're not going to get into percentages, but let's just say this. They're a lot better than most people because I have the most amount of tools to put the deal together. And I didn't bring it with me, but this is my bag. Okay? And inside my bag is another tiny little bag. The tiny little bag is when I go into a house. And inside the tiny little bag is a listing contract, because I might need that. There's a subject to contract. There's a seller financed agreement of sale. There's a regular agreement of sale. There's everything that I need in there to put the deal together. Any one of there's actually more ways than 6, but we don't have enough time tonight. So everything is in there. I'm totally prepared with all the contracts in the bag to make it happen. Now, Jeremy and I are working on something in the future.
Sell Phil's bag.
We're gonna Phil's bag, okay? Phil's bag is gonna be it's gonna be a all-day seminar, and you're gonna get the actual contracts and everything in Phil's bag. It's very valuable. So we're gonna announce an all-day seminar about that coming soon. So it's gonna be called. It won't be called Phil's bag seminar. All right. So it's about 8:35. You guys. You got a couple things you want to finish up with?
I just want to promote.
Okay. Well, go ahead. Let's hear about it.
Phil told you about. He's got books. Addicted to Real Estate book. If anybody doesn't have this book,
It's a really good book.
yeah, I think it's $21 because the years passed. He said 20, but he's got 21 years experience now. This is like the book that I have that I could sell you guys. I'd be happy to if you'd be happier with this book than $20. I'd be happier than $20 because I have a surplus of these books. But they're great. They're great. But I can only read. I've read them already. But this is Dan Kennedy, the marketing guru. Dan Kennedy. It was a book, and when Ron LeGrand, when I bought his first package, I spent like 10 grand in one weekend. It's like big expo thing. And one of the books he gave away with his package was The Ultimate Success Secret, and it was just a little paperback, little tiny thing. Well, this is now expanded. There's a lot of Philadelphia business entrepreneurs in here. Justin actually wrote a chapter of the book as well. Justin wrote a chapter in here. I wrote a chapter in here. There's a bunch of these are all like Philadelphia entrepreneurs that wrote part of this book here. Each of them's his is 21, mine's only 20.
Actually, I can't charge more for the book just because I've got 21 years. But if you do the math now, the price has actually gone down per year.
Per chapter.
Because it was 21 years, you know, for only $20. So now it's like 91 cents a year. It's actually getting cheaper as every year goes by.
So this is, the other thing that I wanted to promote is two things with this. We have a brokerage, Realty Mark, and Realty Mark is like it's pretty much a game-changing brokerage. I know a couple of your brokers, you're Remax, right? All right, so it's kind of like Remax, 100% commission, right? Except for you only pay $100 a month to get this plan. 100% commission for $100 a month. So if you're an agent, or you're thinking about becoming an agent, you can get to keep 100. Your broker doesn't get to steal any of your commission. You get to keep, did I say steal? I'm gonna start sending checks, copies of checks. This is what your check would have been if you closed that last deal with us. You know? But we're looking for agents. Would you think we're investor-friendly office? Yeah. Yeah. So you gotta get to hang out with us in the office and you know, come in there, do closings, meet our title people, do all that stuff. But for $100 a month, you can become a realtor in our office, and you get that exit strategy that Phil's talking about. I can't buy your house, but why don't you let me see what the market can do for you? And now your exit strategy, all those houses that you walked out of that you couldn't buy, boom, get the listing contract, and you can even refer it to somebody who'd be willing to deal with it in our office rather than deal with it yourself. You can say, you know what? I got the listing agreement, but I'm going to put co-listing there. You know, Joe Blow, that's in the same office. Joe, here's a contract. You're on it. I'm on it. Give me 25% when you're done. And that's another exit strategy of houses that you can't buy. So the other thing with this is we are looking for, and I'm only looking for about 10. This is I'm dealing with the MLS and the trend people, and we have a subscription that we can have for unlicensed assistants in our office. We need people that want to learn real estate, learn how to run their own comps, where you get your own login and password. You know, we don't do any of this like you're going to share a password with somebody. You get your own access to the MLS. There's certain things that we have, certain requirements that we have, but for $59.87 a month, $59.87 a month, you can have access to the MLS, and we'll even have the trend people come out and do a training on how to use it and all that stuff. So you can run your own comps. You can look at public records. You want to know if somebody's house has a mortgage on it or not? You pop into the public records side of the MLS, pull up their house, it shows you the last deed, shows you the last mortgage. So is that pretty cool or what? You can go out, going out to the house, you already know if there's a mortgage on the house or not. A lot of times,
download lists.
You can export 5,000 public records names, so you can actually do searches for show me all the duplexes in Central Bucks School District, and you can download that list and send a mailing out to that list. There's a lot of things
It's
you
an
can do.
incredible tool is what it is.
Yeah. So we're bundled up. So for $59.87, that's a monthly thing that you can subscribe to. If anybody's interested in that, just come see me. I want to. We have like 10 that we can do in the office for now, and then we're going to expand it later. But so that's another thing. So you can, you know, for $100 you can become an agent and do the agent thing. You get 100% of your commission. But you just need it, like most of us need it for research. Like we want to look at, if we're going to buy a house, how do you know what the house is worth? You can go to Zillow, but if you're putting dollars on the table, you know, I want to run full comps. I want to see what the interiors of those properties look like when they sold. I want to see the descriptions. You know, Tom's an appraiser, he knows. You know, Zillow's fine, right? You don't need appraisers.
Right. If you want to take a tax assessment as a guy to your house, sure.
Yeah. So there's some really good value out of that, and also you can see there's a lot of information. So if you know, access to MLS is something that I think you know, it's really, I don't know how you can not have that kind of a tool. And if you're sharing it with if you're sharing your password with a realtor, we actually have a legal way that you can do it in our office. So yeah. So that's what I have to offer. Anybody interested in that, the MLS thing? Raise your hand.
I'm interested
Raise your
in
hand.
that.
Okay. So I probably already have your business cards, but maybe just put your name. We'll find your, you know, come up here and just give me your card again and put MLS on it. And any agents that want to hear more about the $100 a month, 100% commission plan, we can do like a private thing where we can sit down and talk about it. Phil's been a recruiting machine for our office. We also have.
How many do you have now?
It's 10 in 9 weeks. So.
Nice.
Yeah. It's the easiest thing in the world to sell. Let me see. You're paying 64% of Keller Williams. We pay 100.
You're paying How much you pay a
Ask
month?
the agents in here, what would be an objection? If
How
any-
much do you pay a month at Remax? A lot?
$3 grand? How much?
1,500?
I got a great deal.
Great deal. Better than 100%? So, who else is an agent here? What's your deal, what's your program?
I'm Cassidy, I just went with them, I've had like really 15 years before that, but Cassidy, probably 40%.
40%, okay. So there's a, for 100, if you're willing to bet $100 a month on your own abilities, that's really what it comes down to.